Okay. So for the first 4 chapters of this semester, we've looked at service industries. Okay? You go out, you perform a service, you cut someone's grass. It is considered fees earned. So we have gone and we performed a service. When we get paid in revenue, it's fees earned. In this chapter, we are moving into a merchandising business. Okay? So they are different than a service business. And we talked about a few of the differences in chapter 1 when we laid out service, merchandising, and manufacturing. We're going to pinpoint those a little bit as well today. So we're only going to look at the first 2 objectives in this chapter. Now, why are we only looking at the first 2 objectives? The book goes into a lot of detail about returns, specific types of returns, inventory shrinkage, things like that. And while those things are important, I don't necessarily think that, what's the right way to word this? For the broad spectrum and for our base knowledge of a merchandising business, I don't feel like they're the most important things. So I just want to hit on the high points and what I feel like is most important to know when we talk about a merchandising business. Now next week we're going to start chapter 16, which is the statement of cash flows. Okay, so we're just going to spend this week in chapter 6, but the things that we're going to talk about, I feel like are vital to your base knowledge of accounting. Okay, so when you look at these 4 financial statements, what do you see that's different? Well, you may not be able to see it. So there's some account titles that are highlighted. And these are account titles that we haven't seen before because we've been looking at a service industry. So when you look at a merchandising business, the way that they account for their business is different than a service business, which makes sense. They sell different products. They account for their items different. Still have the same rules, but the products that they sell, the processes that they go through, things like that, those are going to be different. So let's look at the different accounts that we see. And we're going to get into these as we get into the chapter. So when you look at the income statement, for a service business, the amount of revenue and the way that we recorded revenue, we used fees earned because we are actually going out and we are earning these fees. With a merchandising business, that's going to be considered sales. So a merchandising business is like Walmart. Okay, they sell 1 million different products. They may make some of them, but some of them they go and buy from vendors. Take milk. So Walmart sells milk. They don't own all these farms where they milk the cows and all that. They buy the milk from farmers. So every time that they make a sale, what are they interested in? The profit, right? All right, so how do we figure out what profit is? Well, we're going to take what we sold it for, which would be sales, but then we also have to factor in what did it cost us to acquire that good and then sell it. And so we have another new account called cost of merchandise sold. We'll get into how that plays into the accounting equation. So for a specific product, we're going to be able to look at sales minus cost of merchandise sold and then figure out what is gross profit based on that item or that sector of the business and things like that. Okay? Now, when we look at the balance sheet for a service industry, we didn't necessarily have inventory. You know, we went out, we performed a service, so we didn't have this inventory that we were trying to push through our store. When you talk about a merchandising business, like Walmart, you have a lot of inventory. And so if you're talking about milk, we don't want that inventory to sit on the books for too long, do we? You don't want your milk sitting in the store past the due date. So we want to have a high inventory turnover when we're talking about certain products, like milk, But then if you look at a different type of merchandising business, like say a jewelry store, their inventory turnover might not be as high. So jewelry stores might have diamonds that they've held on to for years, just waiting for the right buyer to come in. So, but that merchandise inventory, that's a new account that we have for merchandising businesses. All right. So what is the nature of a merchandising business? So the activities of a service business differ from those of a merchandising business, obviously. And we're going to see those differences played out in the operating cycle of those businesses. So let's look at the operating cycle. All right, so when we look at the operating cycle of a merchandising business, so the merchandising business, they go and they buy this merchandise. All right, they bring it back to their store, and then the end goal for them is to sell those goods. All right, and then once they sell them, we know there's either two ways that a customer can pay for goods. They can either pay for cash, pay by cash, or pay by accounts receivable. So the sales process is still going to be the same. We're still going to need to get cash, or we're still going to allow them to purchase it on credit. But the end goal to make a profit is still the same. It's just the means of procuring those goods is different, and the way that we earn our revenue is going to be different. Okay? So like we just said, like I just said, the time to complete the operating cycle is going to differ significantly based on the type of business. So when you look at Walmart, and we're talking about the milk section of Walmart, this operating cycle is going to be very quick. I think milk, it may last 10 days, 14 days. So the amount of time between going and procuring that merchandise and turning it around is really quick. When we talk about a jewelry store, it's not so quick. They don't mind holding on to a really expensive diamond for months or years because of how valuable it is. Now, milk, while it is valuable in bulk, it's a different type of inventory. So depending on what type of business we have, that operating cycle is either going to be really quick or it's going to be slowed down. All right, so we looked at those financial statement differences. Here they are in comparison form. So the differences between a service business and a merchandising business, when we look at their financial statements, are easily seen. So what we've looked at, chapter 1, chapter 2, and chapter 3 and 4, is this right here. Okay? We were trying to find out net income. The way that we did that, took total revenues, which we journalized as fees earned, took total expenses, and then we subtracted the two. And what we were left with was either net income or net loss. Now on the merchandising side, that's eventually what we're going to get down to, is operating income or net income for our purposes. So we're still trying to solve for the same thing. It's just with a merchandising business, we have this extra step because we've gone out and we've purchased these pieces of inventory from another vendor, and then now we have to sell them. So when we make a sale, we have an extra step. We can't just take sales price and say that that's profit, because we just talked about we went and bought that. So we have to take the cost that it cost us to acquire those goods to be able to figure out what our net income is. Okay? So we already know this, but for a service business, they're just trying to provide a service for their customers. All right, so fees earned is the only type of revenue that we have. And then we have these operating expenses, which are the cost to allow us to do business, like salaries and things like that. Now, in contrast, when we talk about a merchandising business, we have buying and selling. So in essence, we're going to have an additional journal entry every time that we make a sale. Okay. So a merchandising business first purchases this merchandise from a vendor to sell to the customers. So whenever we make a sale, we are going to record an asset and record a revenue. So that asset is either going to be cash or accounts receivable. And then our revenue is going to be sales. Okay? That's every time we make a sale for a merchandising business. But we're going to have another journal entry as well. And the reason is, associated with this sale is the cost that merchandise was to us. Okay? So when the merchandise is sold, the revenue is reported as sales, and the cost has to be an expense. All right, and that expense is going to be called cost of merchandise sold. And we'll see this worked out in a problem as well. Okay? So, when we make a sale, we always have to have two journal entries if we're talking about a merchandising business. The first is to record the sale, and then the second is to record the cost that those goods were to us. Okay, so we would debit cost of merchandise sold, which is an expense. And then second, when we go back and look at the balance sheet, so we have this inventory that's sitting on our books. So when we make a sale, we're no longer going to have that inventory because we've sold it to a customer. So we have to get rid of that inventory. So the credit on this second journal entry is to credit merchandise inventory, to represent that inventory leaving our store, leaving our books. So every time that we make a sale as a merchandising business, we have to record two journal entries. The first entry is to record the sale. The second entry is to record the inventory being sold, and at the same time, recording the cost that it cost us to purchase that inventory. All right? So why do we do that? Well, we want to look at gross profit for that item. So if you take sales minus cost of merchandise sold, that gives you gross profit for a particular item. And gross profit is it's a very vital tool in the merchandising business world, because if you're trying to sell an item and you're not making a large enough profit or a certain profit percentage on that item, chances are you're either going to discontinue it or try and do something with it. Lower cost, up the sales price, one of those two. And then whatever inventory that we're left with at the end of the accounting period, that's obviously an asset that's going to be sitting on our balance sheet. Okay? So let's look at a problem. Okay. So gross profit is sales minus cost of merchandise sold. All right, so in thinking about that, this says during the current year, merchandise is sold for $250,000 in cash and $975,000 on account. Cost of merchandise sold is $735,000. What is the amount of the gross profit? Okay. So if gross profit is sales minus cost of merchandise sold, what do we use for sales? Do we just use cash? Do we just use the sales that we had on account? Or do we combine the two? Hey, David, if you're on your phone again, I might have to ask you to leave. All right. So yeah, we combined the two because we're talking about total sales. So the 250 in cash counts the same as far as a sale as the 975,000 that we sold on account. So we would add the two together, which is $1,225,000. Yeah. So we had total sales of $1,225,000. Okay, then of that 1.225 million in sales, the cost to us to purchase all of those items of inventory was $735,000. So if we take total sales of 1.225 million and we take out the cost to purchase those goods of $735,000, and what we're left with is our gross profit. Okay? Which is $490,000. That's easy enough, right? And that makes sense if you think about it. So when you think about what is our gross profit? Well, it's whatever you sold. So that's our gross sales. But you have to take out what you spent to buy those things. So total sales minus what we spent to get it is going to give us gross profit. And that number, the gross profit equation, that's never going to change. Okay? So the main hiccup that you could have on a test would be getting or somehow forgetting to add these two together, forgetting to add total cash sales with total credit sales as well. So pull up our homework too. All right, so let's look at our homework. So in our homework, same type problem. It's just asking you to solve a different part. All right, so this says for a recent year, Best Buy reported sales of 42,879 million. Gross profit was 9.961 million. What was the amount of the cost of merchandise sold? All right, so we're still using the same equation. Sales minus cost of merchandise sold equals gross profit. It's just we're trying to solve a different piece. All right, so to solve this, all you had to do was subtract 42,879 minus 9961. So it's 32,918. So the cost of merchandise sold was $32,918 million. Dollars. All right, so same type problem. It's just asked a different way. All right, we'll get there in a second. I don't want to jump ahead. Okay. So going back to our book. So merchandising transactions. All right. So, back in chapter 2, we started looking at this company, Net Solutions. And they began as a service business. We looked at all of their first month initial transactions, and that's kind of how we learned our journal entries. All right, so we're looking at the same company, and this section illustrates merchandise transactions for the same company after it becomes a retailer of computer hardware and software. So basically the company's changing from a service business to a merchandising business. Okay? So let's look at some of these. So the first thing we need to understand is the chart of accounts. So when you look at the chart of accounts, everything stays the same between the service business and a merchandising business except for 3 accounts. Number 1 is sales. So So in a service business, that's considered fees earned. The second account that changes is cost of merchandise sold. So obviously, in a service business, we don't have cost of merchandise sold because we're not selling actual goods. We're providing a service. So cost of merchandise sold is an expense. And the reason it's an expense is because it's a cost to us to go and procure these goods, and we have to be able to figure out gross profit. So if sales is revenue, then we have to offset that revenue with an expense to be able to figure out our profit. So that's why cost of merchandise sold is considered an expense. And then lastly, we have another asset, which is merchandise inventory, and this is reserved for inventory that we have left on hand at the end of the period. Okay? All right. Now I had somebody, I don't know if it was it may have been in my online class, to ask me what do these numbers represent? Like 100, 400, all those things. So, let's see if it'll expand. Yeah, all right. So, for most companies, their chart of accounts, they have a system, all right? Starting with assets, they just started with the number 100. There's no rhyme or reason other than, in a chart of accounts, you start with assets and you work your way down. So the assets started with 100, and then you could have gone 100, 101, 102, but the reason they skip around and they go from 110 to 112 is, say that you have multiple bank accounts, okay? And every time that you make a journal entry, you have to pick a specific bank account. You're going to have to call these out separately. So you might have 110, 111, or you more than likely have more than 3 digits. But you have to have that variation to be able to have the detailed accounting records that we need. So generally, assets are the 100s, liabilities are 200s. Well, this won't get any bigger. Oh, here we go. Owner's equity is 300s. Income is 400s. Expenses are 500s. And then miscellaneous accounts that are not very prevalent are the 600s and 700s. So that's just a general rule of thumb. Obviously, if you open up a business, you can do it any way you want to. But that's pretty standard across the board for companies. So, all right, so let's look at a transaction. Okay. So we said in a merchandising business, you are going to have inventory. Okay? If you have goods on hand, you're going to have inventory. It's very unlikely that you will sell out of your inventory every time at year end or every time at period end. So most companies are going to have inventory on hand at the end of an accounting period. So in saying that, there's 2 different ways that a company can track their inventory system. One is called perpetual and one is called periodic. So in a perpetual inventory system, every time you make a purchase of inventory or every time you sell inventory, a journal entry is created. Now in the computer age, most companies have a perpetual inventory system. There's a lot of pros to that. At any point in time, you can know exactly how much inventory you have on hand. So you could go at 12 o'clock in the afternoon on a random Tuesday and say, hey, what do we have in the inventory system? You can pull up the computer, and obviously it's going to have every sale and every purchase tracked. So it's a very accurate system. Every transaction is accounted for. One of the downsides to it is that it's more expensive than a periodic system. Okay, but a perpetual inventory system tracks every purchase and every sale. Now compare that to the periodic system, and the name gives it away. You only update your inventory periodically. So the inventory does not show the amount of merchandise that you have for sale and sold at any point in time. So if you went today and you said, hey, how much inventory do we have on hand? Well, we have our beginning balance of inventory, and then we would have obviously made journal entries anytime that we purchased more inventory, but you wouldn't know exactly how much inventory you have on hand. So with a periodic inventory system, you only update it at month end, or at period end. The way that you do that is you go through and do an actual physical inventory count. So how many of you guys have been to Dirt Cheap? You guys go there a lot? I've never been to this one, but do they just have bins of stuff with like random stuff? All right, so when I worked at KPMG, every year, so 2008, 2009, 2010, I had to do a Dirt Cheap audit. It was on January 1st every year, so I missed the Cotton Bowl twice for Ole Miss. So what that entails, so it was normally on a Saturday. So on January 1st, they would have their stores closed. We would go in 7 o'clock in the morning, and they would print out an asset register. So that would list every single thing that they consider inventory in that entire store. So you think about Dirt Cheap here, all those bins, everything that's listed in there, or everything that's in there is considered inventory. So all of that stuff would be on this register. And we would have to go through the store and count to make sure everything they have that they are counting as inventory is present in the store. So it'd be an all-day affair, every coat, everything. But then at the end of the day, if you have discrepancies, so say that they have on their inventory register that they're supposed to have 50 strollers, but we go through and we count and they only have 35. Well, that's a pretty big discrepancy, and I mean that could be a material amount that could cause a problem. So you do these inventory counts to know exactly how much inventory you have on hand. So the positives to a periodic inventory system is that it doesn't cost as much. So you're not constantly updating your records. You don't have to use the computer software. If something breaks down, you don't have to call in a technician. So the cost is a little less, but the downside to the periodic system is that you don't always know how much inventory you have on hand. Okay, so each business has to have to weigh the pros and cons to see, do we want a perpetual system or a periodic system? So, and like I said, with the computer age that we live in today, most companies use a computerized perpetual inventory system. Okay. So because of that, we're going to assume that all these companies are on the perpetual system. All right, so let's look at a journal entry. So when we make a sale as a merchandising business, so under the perpetual inventory system, cash purchases of $2,510 of merchandise is recorded as follows. So if we're a business, we go out and we buy inventory. How should we record that? First of all, inventory is an asset to us. So we would debit merchandise inventory for $2,510. Now, how do we buy that? In the first instance, we paid for it with cash. In the second instance, it says that we purchased $9,250 of merchandise on account. So, same type deal. We still received inventory, which is an asset. But in the second example, we bought it on credit. So this represents a liability, a promise for us to pay this customer or this vendor at a future date, okay? So whenever you go and you buy inventory, the terms of the purchase, when you purchase something on account, are going to be listed on your invoice. So, if you go and you buy, if you go and you pay cash, the transaction is done as soon as you walk out the door, right? So if you go and you buy a shirt and you pay cash for it, you don't have to come back 30 days later and pay the rest because you've just paid for the whole transaction. If you bought it on credit, then there's an assumption there that you're going to come back at whatever time period is agreed upon and pay the rest of this bill, right? So when you buy it on credit, it's not paid for, theoretically, that day when you walk out. So when you buy something on credit, or when we sell something on credit, there's a time frame that we have to complete that transaction, okay? And so that's what this is talking about right here. Terms of purchases on account are normally indicated on the invoice or bill that the seller sends the buyer. And then the terms for when payments for merchandise are to be made are considered credit terms. All right. So, and then there's all these different terms. If payment is required on delivery, then the terms are cash or net cash. But what we are trying to talk about here is a discount. All right. So if you're a customer and you buy something on credit, if you're the customer, why would you buy something on credit? Let's talk about that first. Why would you not just pay cash if you go and you buy something?
Maybe you don't got it right now.
Okay, that's one possibility. So you may not have the cash right now, but you really need this item. And so you buy it on credit in hopes that, so over the next 30 days, you come up with the cash. What's another option? So think about if you're a business and you have just a very large amount of cash that is sitting in the bank. And that cash earns interest as it sits in the bank. That cash might be more valuable to you to sit in the bank over those 30 days and collect interest as opposed to paying cash on day one whenever you go out and buy this item. So if your cash could earn you more money as interest sitting in the bank for 30 days and there's no penalty for you holding on to it, then that would be a reason that you might not pay cash, right? So from a business perspective, it might make more sense for you to leave your cash in the bank, wait until the last possible minute to pay for it, and then allow it to collect interest. Now, if you're a vendor and you own a business, why would you allow a customer to buy something on credit? If you own a clothing store, do you want to be a cash-only store? Possibly.
I wouldn't want to be a cash only store
Why not?
because it'll limit the amount of sales and profit
Yeah.
that we're gonna make.
Right. 'Cause somebody might not come in if they can't buy it on credit. So by being cash only or not allowing credit purchases, you could be undercutting your sales. Now, what's a risk that the owner enters into when they allow a credit purchase?
Not give them money.
Yeah. So you make a sale to somebody, they have 30 days to come and pay it back. What if they don't come back? Then, that happens a lot. So then you have to try and hunt them down. And if you can't find them, then you have to turn it over to a credit agency. And so there's this long process for you trying to get the money that this customer should have paid you. So there's pros and cons to both sides, as in most things in life. So as a business owner, you have to decide, am I going to allow credit purchases? If I am, what can I do to incentivize a buyer to pay me early? And that's what I'm trying to get with this. So businesses, if you are the vendor You want your customers to pay you as soon as possible. But we just said that for most businesses, it doesn't make sense for them to pay cash right away because they can earn interest on the money that's sitting in the bank. So these vendors have come up with a discount to entice their customers to pay them early. Okay? So if a payment is due within a stated number of days after the invoice date, so if a payment's due in 30 days, then the credit terms for that purchase are net 30 days. And that may be written as in 30. All right? So that means the net purchase is due within 30 days. And these are considered credit terms, if I lost you with my explanation. Okay? So this is where the purchase discount comes in. So to encourage a buyer to pay before the end of that credit period, the seller may offer a discount. And this is very common. So for example, a seller may offer a 2% discount if a buyer pays within 10 days of the invoice date. Okay? And then if you don't take that discount, then you have 30 days to pay the full amount. All right, so in that case, these would be the credit terms. And you read this, a 2% discount if it's paid within 10 days. If it's not paid within 10 days, then the net amount is due within 30 days. You guys see that? Let's go over that again. So this is considered a purchase discount within the credit terms. So if you see this means there's a 2% discount available if the balance is paid within 10 days. If it's not paid within 10 days, then the net amount is due in 30 days. So then the buyer has to decide, is it more advantageous for me to take this 2% discount, or is it more advantageous for me to let my money sit in the bank, forego that 2% discount, and pay at the end of the period? Okay. The good thing about this chapter in the book is that we are going to assume that all customers are going to take the discount. Okay, but in real life, that's not the case. In real life business, most businesses forego discounts because if you have $1 million sitting in the bank, you're going to earn more interest on that than taking a 2% discount. Okay, so discounts taken by the buyer for early payment are called purchase discounts. And the purchase discount is going to reduce, obviously it's going to reduce the overall amount of their purchase, but it's going to reduce the cost of the merchandise that they purchased. Okay, so let's look at an example. All right. So this says, to illustrate, the invoice shown on Exhibit 3 is used. So the last day of the discount period is January 15th, all right, which is the invoice date plus 10 days. So assume that in order to pay the invoice on the 15th, I don't like that example. Just kidding. It's a little more involved. So it takes into account the interest that they would have earned. Our problems are not going to be that difficult. Let me go find this, an easier one. Sorry. Go back to our homework. All right, we'll just talk about the part that matters right here. All right, so the last day of the discount period is January 15th. So the piece that I want to look at is to assume that in order to pay the invoice on the 15th, they are not going to owe $3,000. Okay, they're going to owe $3,000 minus that discount. So a 2% discount on $3,000 is $60. So instead of owing $3,000, they would owe $2,940. No, we're not gonna mess with the rest of the stuff there. Okay, then like I just said, since buyers normally take all of the purchase discounts, we're gonna debit merchandise inventory for the net price. All right, so if $3,000 is the original stated price, and they offer a 2% discount, which is $60, then the amount that they pay is $2,940. So that is the amount that would be recorded as merchandise inventory, and then that's the amount that they would owe as an account payable. Now, if the invoice is paid within that discount period, it'd be the $2,940. If the customer decides not to use the not to use the discount, then they would owe the full amount, which would include that $60 of the discount that they forego. So whenever they paid that invoice off, they would have to add an additional $60 for the discount that they chose not to use. Let's see here. We'll skip that. I'm running out of time, so I'm going to take off some of the stuff that I was going to talk about. So let's look at this. Purchase transactions. This is what I was trying to get to earlier. So here are some examples. All right. This company purchased merchandise on account from a supplier for $11,500. Okay. With the terms 210 and 30. All right. So before we go any further, these credit terms right here, this means if we pay this invoice within 10 days, we are entitled to a 2% discount. It's not mandatory that we pay it within the 10 days, but if we do, we're eligible for a 2% discount. If we choose to forego that and not pay the balance within 10 days, that's fine. It's just we owe the net amount in 30 days, okay? So, then they also say that they returned $2,500 of the merchandise and received full credit. All right, so if Roeffel's company pays the invoice within the discount period, what is the amount of cash required for the payment? All right, so let's think about this. If we bought $11,500 worth of goods, but we returned $2,500, how much did we actually purchase? So we actually purchased $9,000, right? Make sure I did this in order. No. All right. Do it like that. So if we had 11.5, that's the amount of our original purchase. We have to take the 2% on that. Then we returned $2,500, and we take the 2% on that. Then the actual amount that we would pay is $8,820. So the net price after the discount is $11,270, less the return of $2,450. So you have to take the discount individually. So it'll be $8,820. All right. we're gonna work on another problem before we leave. And then under a perpetual inventory system, what account is credited by Rofol's company to record the return? We're actually not, so due to time constraints and the fact that we're only spending one day on chapter 6, we're not gonna do returns. So as far as our test, what I want you guys to know and what we're gonna be tested on in chapter 6 is the differences between a merchandising business and a service business. So we talked about the different accounts, sales, merchandise inventory, and cost of merchandise sold. And then I want you guys to be able to record an initial purchase, which is a debit to either cash or accounts receivable, a credit to sales, that's the first entry, and then a debit to cost of merchandise sold, and a credit to merchandise inventory. Okay. The rest of the stuff we're not gonna have time to cover. All right, so we have 10 more minutes. I want to cover the actual sales, which is this stuff right here. Okay, so with a cash sale, when you make a sale with cash, there's no need for credit terms. Why would there not be a need for credit terms when a cash sale is made? So whenever you go and buy something and you pay cash, it's done. You don't owe any more money. The transaction is complete. You've paid for the good. You've received the good. So there's no need for any further transactions to take place. So when you make a cash sale, that's it. That's the end of the transaction. So when a cash sale occurs, you would debit cash and then you credit sales. Now, in saying that, every time that we make a sale, whether it's cash or by account, you have to have 2 journal entries. The first is to record the sale. The second is to record the cost of the merchandise that we sold. Okay? So in this case, we had a sale of $1,800, but the merchandise that we sold cost us $1,200. So the first journal entry would be to debit cash, credit sales. Then the second journal entry would be to debit cost of merchandise sold, which again is an expense, and to credit merchandise inventory, which is an asset. So with the first journal entry, we receive cash because we made a sale. So we are increasing this asset, which is cash, and we are crediting sales. So sales is a revenue account. So by crediting sales, we are increasing sales. The second journal entry that we are making, we are debiting cost of merchandise sold. Cost of merchandise sold is an expense. So by debiting that expense, we are increasing cost of merchandise sold, which makes sense. We sold this merchandise, so the cost of merchandise sold should increase. And then in the second entry, we are crediting merchandise inventory. Merchandise inventory is an asset. So by us crediting this asset, we are decreasing the amount of that asset. That makes sense as well because we've sold these goods. So we no longer have them in our store, in our warehouse. So we shouldn't have them sitting on our books. So that's the purpose that we make these 2 journal entries every time we make a sale. All right? That's a cash sale. A credit sale works the exact same way. The only difference is instead of cash, we're going to debit accounts receivable. So in the first journal entry, we debit accounts receivable. That means that this customer has agreed to pay us this amount at a date in the future. We record sales as a credit entry because sales is a revenue account. So by crediting revenue. We are increasing our revenue. And then secondly, this entry always stays the same. We debit cost of merchandise sold, which is an expense. And then we credit merchandise inventory, which is an asset. And the reason we debit this expense is we have to actually recognize the cost of those merchandise items that we sold, and then we credit this inventory because we no longer have it on our books. Okay? So we're not going to worry about, do I want to do that? What do you think? Do you guys want to have discounts on the test? I think. Well, I would have to replace I'd have to replace them with other questions. I think I'm gonna take that off. I think we're gonna be too pushed for time. All right, so if you'll scroll down to the bottom of that page, there's another problem right there. Okay? And I want us to look at part A and part B. Okay? And this will be it. We'll end with this today. So, yep.
Is it the purchase?
This is a sales transaction. So we already did the purchase. So yeah, this is sales. All right. So part A says we sold merchandise on account to this company. With terms, it was for $7,500. With terms, 210, comma N30, which means with the credit terms, we'd offer them 2% discount if they paid within 10 days. If they chose to forego that, the net amount is due within 30 days. The cost of the merchandise sold is $5,625. Okay? So, before we ever do anything, we can go ahead and start our journal entries and have everything set up before we ever need to input a dollar value. Okay? So we know that this is a sale that's on account. So we are going to debit accounts receivable, and we're going to credit sales for the first journal entry. And then for the second entry, we know that because we made this sale, we have to recognize the cost of the merchandise that we sold. And then we also have to get rid of this merchandise inventory that we are selling. Okay, so before we put any dollar values in, that is what our journal entry should look like. Okay, so now we just need to figure out what dollar values go in there. All right, so it was $7,500 was the amount of the sale, and then we offered them a 2% discount. If you said 7,500 times 98%, 7,350. That's the amount of the sale that we recorded. 7,350. Okay? They give us, and they will always give us, the cost of the merchandise sold. Okay? They're not going to ask you to figure that out. It'd be way too detailed and way too complicated. So the cost of the merchandise sold is $5,625. Okay? And I was just worried about part A. So, can you record a sale either in cash or on account? The amount of questions on the next test on chapter 6 will be very limited, just because there's not that's really all the pertinent information that I feel like you guys need to know. So you'll see very few questions on it. The bulk of the test will be chapter 16. Let's see. I think that's all I've got.